Friday the 20th of July on Sky 1. And if you missed out on the first 2 series of Lucky Man, both seasons are available now with Sky box sets.
The top stories live from the Sky News City studio. Running the NHS at 70, I'll speak live to the Chief Executive of the Major Hospital Foundation Trust. The Telegraph Media Group posts a 50% drop in profit. I'll ask the Chief Executive if the shift to digital is paying off. The growth of esports, I'll speak to the Executive Chairman of a leading tournament organiser and have a go against a pro. And merchant banking for the millennial generation, the changing shape of wealth management in the city. Good evening. A budget of more than £120 billion a year, almost 1.5 million staff, serving 65 million people but not charging them directly. We're talking, of course, about the NHS, which celebrates its 70th year this week. Well, there are challenges: a growing and ageing population, health inflation and the constant need to make savings. But there are opportunities: a recently announced budget boost and technological advances. Well, as part of Sky News' special coverage all week, I'm joined now live by the Chief Executive of Milton Keynes Hospital NHS Foundation Trust, Professor Joe Harrison. Joe, very good evening to you. You've run a total deficit of £44 million over the last 2 financial years. If you were a business, the receivers would have been called in by now, wouldn't they?
They would certainly be taking a close look at how we're spending our money, and I think what we see is that there are better ways of getting good value out of what we're doing in the NHS, and that's what we've got to focus on.
Why is it that I think it's something like 44% of all foundation trusts are in deficit? Why is that?
What we've seen is over the last 8 years an investment in the NHS that hasn't matched the pressures and the costs associated with running the health service. The latest settlement that we've had at 3.4% has given us the opportunity to think about how we invest this funding in new technology and new ways of doing things.
So this isn't fiscal indiscipline then, necessarily?
There are opportunities without question to get better efficiency out of the NHS, and also we need that investment to enable us to look at different ways of doing things.
I think you've highlighted a couple of interesting saving measures. I mean, postage apparently costs £100 million a year.
What we see is that the NHS continues to use letters and stamps to communicate with patients and families, and in most other industries we see better, faster, secure ways of communicating that actually people really like. And so what we're doing at Milton Keynes, with the help of Zesty, another company, is making sure that we use email, we allow patients, families, carers to engage with us, do things online, change their appointments and receive letters online.
So you've said just now there's a lack of investment. The investment hasn't kept pace with rising costs. So the government's putting in £20 billion, this big spending boost. Is that going to be enough?
It's a good settlement, without doubt. Is it enough? I think we have to take a long, hard look at what we provide in the NHS, how we work with the care sector, so social care and our councils, and work out how we get best value for that money. And also make sure that we spend it on things like technology.
But isn't the really interesting thing about the NHS is that whilst the budgets have been quite tight in recent years, its productivity has actually increased. And when Gordon Brown showered it with money in the last decade, its productivity fell off quite dramatically.
Well, we know that what we've got now is a situation whereby we can't just build another hospital, we can't just invest money without thinking about the return on that. We've changed our thinking across the NHS. We're looking at how we work with social care and getting that best value that we know we can really focus on.
Well, if you take the international comparisons, I mean, Germany's healthcare system looks after 82 million people. Britain's NHS, only 65 million people. Yet Germany has more doctors per head of population and fewer staff overall. I mean, that looks like a better run system than the NHS.
And it costs more than the NHS. And we do know that the NHS does deliver very good value. And we also know we can get more out of it. And it's my job and the job of other senior managers across the health service to do that.
So how do you achieve that?
Well, we do need to have a conversation, an open conversation with the public about how we spend that money. We need to have a proper conversation within our hospitals, within social care, within community care about how we can best look after patients. If you're elderly and you're in a hospital bed and you don't need to be, that is one of the most expensive places to look after that person. Let's make sure we invest in our community services. We also know that 1 in 4 people are likely to have a mental health issue in their life. And that then does mean that some of those patients come into our hospitals because of physical needs on the back of that mental health issue. Let's invest in mental health and let's make sure that those patients don't find themselves with physical issues on the back of that.
All right, Joe Harrison from NHS, Milton Keynes NHS Foundation Trust. Good to see you. Thanks for joining me. Now, our City Editor Mark Kleiman has an exclusive news story for us and joins us now live on the telephone. Mark, what have you heard?
Yes, Ian, this relates to Sir Martin Sorrell, the former chief executive of WPP Group, the global marketing services giant, and the company itself. Now, if there was any semblance of a truce between the two sides following Sir Martin's acrimonious departure in April, Ian, that has been well and truly exploded tonight, because what I can reveal is that WPP is threatening to strip Sir Martin Sorrell of share awards worth potentially up to £20 million because of a takeover bid that he has lodged for a Dutch digital advertising agency through his new venture, S4 Capital. Now, this new digital creative agency in the Netherlands, Media Monks, is also the subject of takeover interest from WPP. And what I can reveal, Ian, is that Slaughter and May Magic Circle law firm wrote to Sir Martin yesterday to warn him that a breach of his exit agreement and his confidentiality undertakings that he agreed to when he left WPP in April would mean that he would forfeit outstanding awards under the company's restricted stock plan and executive performance plan. Now, these could be worth, based on WPP's future performance, up to £20 million in total. Now, a source close to Sir Martin's new vehicle has told me tonight that it is, and I quote, a feeble attempt to destabilise his bid for Media Monks, but this really does mean that there is now a full-blown war of words and a legal battle between Sir Martin and WPP Group. I'm told that Sir Martin told his new institutional investors today that it had sought legal advice in response to WPP's letter and believed that the allegations made by WPP's lawyers were without foundation. This is going to develop over the coming days and weeks here.
All right, Mark, thanks for that. And you can read Mark's report on that on the business section of the Sky News website right now. Now, activity in Britain's services sector was stronger than expected last month, raising expectations of an August interest rate rise from the Bank of England. The Purchasing Managers' Index survey, where anything above 50 represents growth and anything below that contraction, came in at 55.1, up from 54 in May. Well, that was the highest reading for 8 months. The latest figures imply that the economy grew by 0.4% during the second quarter of the year, twice the rate of growth during the first 3 months of 2018. Well, weakness in some of the mining heavyweights on the back of the recent drop in copper prices saw the FTSE 100 fall by just over 0.25%. The Chilean copper producer Antofagasta led blue chip fallers. Others on the downside included Compass, the contract catering giant, after its finance director unexpectedly quit. On the upside, ITV ticked higher on news of record viewing figures for last night's England match. Outside the FTSE, Talk Telecom was one of the main gainers as the hedge fund manager Tosca Fund declared a 16% stake. Wall Street was closed for Independence Day celebrations today. On the FX markets, the pound rose slightly against the US dollar and the euro on those solid PMI services figures. The oil price, meanwhile, that's ticked up slightly on news of a drop in US oil stocks. Barrel of Brent crude a short while ago will set you back $78.17 a barrel. That's up 0.5%. Now, it's well known that newspapers up and down the country are seeing a drop in traditional advertising revenue and physical sales. The group that publishes The Telegraph and Sunday Telegraph has today announced a 50% drop in full-year pre-tax profits as a result. But it also reported a 30% rise in revenues from online subscribers, and it's increasingly focused on its digital sales. And Nick Hew is the Chief Executive of Telegraph Media Group and joins me now. Nick, very good evening to you.
Good evening.
At what point will digital revenues overtake lost traditional print sales and ad revenues?
So, by way of context, it's around a year ago that I took over as CEO and rolled out a new strategy that really put quality journalism right at the heart of what we do, but of course with a strong recognition of the need for digital in the future. We are very happy with the progress that we've made against that strategy. In fact, I'd go so far as to say